Okay, so June 1st has now come and gone. The stress test is now implemented. People now are qualifying at 5.25% for their mortgages. And the question now becomes, what does that mean for the economy and the real estate market going forward? And that's what we're going to discuss in today's video, which is my Canadian real estate forecast for the summer of 2021. I'm going to give you all of my predictions and where I think things are going. But before we get into it, do me that favor, please consider subscribing, hitting the like button, and hitting the notification bell. And don't forget about our race to 25,000 subscribers, where we're going to give away $5,000 to one lucky subscriber. All you have to do is click the subscribe button. That's it. That's all. You don't have to get a mortgage through us. You don't have to buy any products. Just being subscribed will give you the information that you need in order to enter the draw. So go ahead, do it. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit: product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the Canadian real estate forecast for the summer of 2021. And I'm going to start with this. I'm going to say the big thing that we need to look out for as economists, as members of the public, as realtors, as mortgage brokers, when we're trying to predict what's going to happen in the real estate market, is we need to look at people's psychology. And it is shifts in psychology that have the biggest impact on the real estate market. We saw this during the pandemic, where in the first 2 months of lockdowns last year, pretty much real estate ground to a halt. And then as people saw an opportunity and a need to have bigger spaces and more space in different types of areas, like not in a downtown core, well, that shifted the market, and it shifted basically the psychology of real estate buyers in Canada. And the question is now going to become, as things seem to be opening up, does that psychology shift again, where people go, well, maybe now I don't need all that space. Maybe I don't want to be in the suburbs. Maybe I want to be in a less expensive downtown condo rather than in a super big house that is super hard to clean, with a big yard that I have to take care of, and all of the things that I never thought about that I would have to do when I bought a house. So this is what we're looking at right now. We're looking at shifts and psychology, and we're looking for surprises in the market, because the thing that changes the market drastically over the next year or 2 or 3 years are going to be the things that we don't expect. They're going to be the things that pop up out of nowhere and basically slap us upside the head, similar to the pandemic last year. So let's talk real quickly about how we got here. I'm going to flip you over and show you somewhat of the headlines here. And as of right now, there are 2 things that are leading the economy. The first is exports, and the second is housing. And these 2 things are basically what's driving us back to normal levels of growth and normal levels of economic activity. And primarily, there's 2 reasons for this. One is because of the change in preferences, so that psychology with respect to real estate. And the second is with respect to exports, and basically there being significant supply chain interruptions across the globe, and that ultimately leading to there being more demand for exports and things that Canada has an abundance of, like lumber, like steel, and like all of the things that go into basically making consumer goods and everything else that goes along with the economy. We're seeing increases to oil prices and so on and so forth. And a lot of the increases to all of these prices isn't so much to do with government spending and injecting money into the economy. A lot of it is just simply supply chain interruptions. And it is simply the fact that supply for certain goods is down substantially, which means the supply line shifts if you've done Economics 101, and that means that the prices go up. Now, the question is, what's going to happen when the supply of all of these goods goes back to normal and inventories are restacked up? Will things come down in prices? And I think the obvious answer to that is yes. I don't think lumber is going to ever come back down to the prices it was before, but I think it will come off its highs, as will other goods like oil and steel and so on and so forth. Now, what's really interesting when we're looking at the market is the early June data that is coming out, and this is for the month of May. Now, everybody expected that in the month of May, with the stress test coming, that there would be a massive rush into the market, and some individuals definitely saw a massive rush into the market. If you were in the mortgage industry or if you were in the real estate industry, some people found it to be very busy. We had a commenter, a nice buyer's agent out of I don't know which market, comment that I was crazy in one of my last videos for saying that the market wasn't as busy as expected. It wasn't. The lenders across the country are saying that it wasn't as busy as it was expected. But, she said that full out, the market is crazy and asked me if I was even involved in the real estate market. Well, the reality of it is compared to other times where there's been a stress test increase, we didn't see the same sort of numbers that we expected. And the early June data, this is out of Montreal, is sales fell 14% between April and May. Now, this could be lockdown related. It could just be real estate fatigue related. It could be a combination of both. But all of those sales that were expected to happen because of the stress test taking hold, they didn't come into fruition, and Montreal's numbers are showing that. And then if you move into Vancouver, again, early numbers out of Vancouver. And by the way, all of this stuff will be covered in our real estate update for June of this year, which will come out in the next couple of weeks when we get all the data from across Canada. But again, looking at Vancouver, sales in Vancouver down 13% compared to April. So again, a cooling off in the market. Was it lockdown related? Was it buyer fatigue related? We don't know, but my guess is we're just simply running out of that supply of buyers, and there's a shift in psychology happening. And that shift in psychology is towards that maybe I want to see what's going to happen with the real estate market. Maybe it's I don't want to be in as big of a house as I thought I wanted to be in. And maybe it's just a general shift to see what's going to happen over the next 2 or 3 months as governments are claiming that the economies are going to open up full force and we're going to be pretty much back to normal. So that leads us to the question of what do I think is going to happen in the real estate market over the next couple of months. Now, there's 3 lines of thinking here, and I'll tell you which line of thinking I have at the end, but I want to cover each line of thinking independently. So the first line of thinking is that housing prices from a nominal dollar perspective, so in other words, it's $1 million to buy a house when it used to be $500,000 to buy a house, are too high, and therefore the market has to crash. Well, that line of thinking, I understand. People often feel like that higher prices are the indication that the market has to turn. But if you look going back to 2016, 2013, there were different markets where people said housing prices have to come down, and they've continued to go up. And the reason why is because it's not so much about the nominal price of the houses that controls the market. It's about the borrowing costs and about the actual cost of owning the home, which is your interest rate, your taxes, and the other things associated with buying and maintaining a property. So I don't think necessarily that the market's going to crash because housing prices seem high is a very good argument, because quite frankly, the argument on the other side of it, which is housing or mortgage rates are low, which means they have to go up, isn't a great argument either, because it's not necessarily true. So that first line of thinking, I think, is not something that is at least in the immediate realm of possibility, unless something unexpected happens, unless there's lots of job losses, unless something changes in the economy, unless something happens with coronavirus where we find out all of a sudden that the vaccines aren't working and we have to go into a perpetual 2 or 3 year lockdown or something like that. It's the thing that we aren't going to expect that is going to come up and bite us and potentially have the market crash. But there's no way of forecasting that. And those types of things only usually happen every 8 to 10 years. So I wouldn't bank on there being a major real estate crash in the next little while. Now, the second line of thinking that could happen is housing prices could continue to go up indefinitely, and we could go up another 15, 20, 30%. Well, I have a little trouble with this line of thinking as well, because we're already seeing, when you look at the news and you look at what is coming out from May, that housing sales are down. Now, that could have, again, been due to lockdowns and there being less activity in the market. And we could see a whole bunch of activity again in July and August and September. However, it may also be that we're running out of buyer bandwidth. And I think that's more than likely the case, because what we've seen in October, November, December was when there were lockdowns, there was still the ability for people to go out and buy and sell houses, and people were still moving. So I don't think the massive increases in prices argument is going to hold, just because, again, it appears very clearly that there is a change in psychology in the market, and there is going to be some sort of cooling. And just in general, in a normal real estate market, when the summer comes, people tend to take time off from buying and selling real estate. It's normal. And I feel like with the world returning to at least a little bit of normalcy, we may see our real estate market and the typical trends return back to normal as well. Now, the third line of thinking, and this is the one that I personally believe is most likely, is that we're going to see a flat real estate market for at least the next 2 or 3 months, and probably the next 3 to 4 years. And the reason why I believe that is because I just think we've run out of buyers, but the fundamentals, and I know people like to argue about what the fundamentals are, but the fundamentals, the cost of borrowing and those types of things haven't changed. Now, one thing that has changed is the stress test has changed, and that is the equivalent of a 5% decrease in purchasing power. So what we may see is we may see housing have hit its peak in some markets with respect to pricing. And what we may see is we may see that back off by 4 or 5%, or maybe 2 or 3% because of the stress test and the effects on buying power and qualifying. But that is yet to be seen. In the past, when the 20% stress test came into effect in 2016 or 2018, I can't remember which one it is, but when that came into effect previously, what we saw was a cooling of the market. Actually, it was both. One was done in 2016, the next one was done in 2018. We saw a cooling in the market about equivalent to what the change in buying power was. So we may see that again. But what I think is really interesting, what is really cool, is that it wasn't the Bank of Canada that did this, but OSFI and the federal government found a way to basically implement a 0.5% increase in interest rates for as far as buying power is concerned in the real estate market without having to increase interest rates across the board on all other forms of debt that is basically tied to the Bank of Canada rate. So I thought this was really, really interesting. They effectively have made that 0.5% increase by increasing the stress test by 0.5% without, affecting other forms of borrowing, which I think was smart. And ultimately, I think it's going to create this cooling and this change in psychology, both from the perspective of people can afford less and there's less need to change the type of living situation because things are looking like they're going back to normal. And I just believe that ultimately what that means is that we've probably hit the max out on the number of buyers. We've probably hit that kind of psychological limit of how far real estate can go, at least for now. And ultimately we're going to end up in a fairly reasonable environment, which I hope means that housing prices remain flat and we end up with less bidding wars. We end up with less craziness in certain markets. We go back to people being able to make a reasonable offer and get it reasonably accepted with reasonable conditions, like a financing condition in place. And hopefully this provides some opportunity for some of those who have been waiting to jump back into those markets that have otherwise been super insane and just absolutely crazy. So if you are looking at getting into the market, I do always give you my little pitch because it's the thing that affords me the ability to do these videos, which is our courses. The two courses that we have right now are Secrets to Getting the Lowest Interest Rate and the First Time Homebuyers Boot Camp. They're both priced super low so that you can come in, pay a very nominal price for it, and ultimately end up with a significant amount of information that will save you 10 to 15 to 20 times what you paid for the course. The boot camp is in effect right now. Secrets to Getting the Lowest Interest Rate is an established course. We've had a significant number of people go through that and have done very, very, very well with the amount of savings that they've been able to get. It talks about things like how to get a lower interest rate. It talks about things like how to negotiate with a broker, how to negotiate with a bank, what you can negotiate in. And there's one chapter there specifically that has pretty much the exact margins that a lender has to work with, and therefore how much you can negotiate off of your interest rate. That one chapter is worth the price of admission alone. I will link to both courses in the description below. The Secrets to Getting the Lowest Interest Rate has a 50% off coupon that is 50% off the already discounted price. So go ahead, take advantage of that. And if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And we will see you on the very next one, and hopefully again in the next couple of weeks on the Canadian Real Estate Update for June of 2021.